what is finding favor? Is it value which is finding favor in the truest sense, or is it value in growth in that you're penciling earnings growth and of course I know nothing gets rewarded if there is no growth, but I'm just trying to understand that are you comfortable paying a slight premium for higher growth, or are you currently of the belief that let me try and be very conservative and not buy something which is even remotely egregious in value, egregious under the current context?
So it's an excellent question, Neeraj, and that brings me to the daily dynamics of what we do. Well, what we need to first accept and imbibe in our action is that there is a change in the global liquidity landscape. The low interest rate monies, which actually resulted in a lot of elevated fees rather than earnings, is behind. So most investors kind of acknowledge that, but they don't put it to action, is what I see. But then we have definitely made sure, given our experience in this arena, that we should do that. If you thought 18p is a good p for this name, you should take it down to 15p or something, because the liquidity landscape has changed, and globally, at least in the developed world, debt as a genuine asset class, given where the yields are, is emerging. And a lot of pension and endowment money will actually get allocated in that direction. It might be a different case in the context of India, but at least globally, we would see, because yesterday the US 10-year ended at 3.9. So it's a legitimate investment avenue for a lot of pension funds, for a lot of endowment funds. So we will see money getting reallocated from equities, at least in the developed world, towards fixed income. So that we need to recognize. So that will continue to keep pressure on even emerging market equities. Having said that, the growth prospects of businesses and economies are very, very different. And India is a shining star in that. We are seeing high frequency data, be it the port traffic, be it the freight, be it even capacity utilization in the systems. We are clearly seeing, upward trends. Now, that's a very good sign. It also means that we would at some point start talking about capacity expansion. And that's something that has been missing in the system, which is, I would call, the real growth in last 10 years. Last 10 years, we've come out of a decadal low, capex intensity. But if I look at data, the last 10 years, 2012 to 21, the capex in the system has grown at a meager 1.9, 1.8% CAGR. That's amongst the lowest we've seen in the last 25 years. So I think a lot of consolidation that had to happen, a lot of deleveraging, a lot of balance sheet repair that had to happen, or equity infusion for bad assets in the case of financials has happened. And we look forward to a lot of announcements which continue to happen in the capacity expansion side. So that's what we think is the real play on equity investing.